If you're a Canadian accountant, there's a good chance you're leaving $100,000 to $500,000 on the table every single year. And the worst part, you're doing the work that creates this money and you're not getting paid for it. I'm Mantek Sekho, and I've been working with Canadian accountants since 2019, helping them understand what I call the referral trap, a practice that's costing every accountant practically hundreds of thousands of dollars over the course of their career. In this video, I'm going to give you a breakdown on exactly what the referral trap is. I'm going to show you the real numbers behind it and explain why it's happening. And I'm going to help you walk through an alternative that looks better. This isn't a sales pitch. This is purely educational. At the end of this video, you'll understand a dynamic in your practice that most accountants never think about. And you'll be able to make an informed decision about what you want to do with that knowledge. So let's get into it. So what exactly is the referral trap? Here's what's been happening in most accounting practices. And I want you to think about whether if this sounds familiar or not. A client comes to you, maybe they're a business owner with excess cash sitting in their corporation. Maybe they're a high-income employee who wants to reduce their tax bill. Maybe they're approaching retirement and asking about planning options. These are real financial needs, and as their accountant, you're often the first person they come to because you see their tax returns, their corporate structures, their income, their whole financial picture. But here's the thing. Solving these problems usually requires financial products like insurance, investment strategies, and retirement planning vehicles. And most accountants don't offer those. So what do most accountants do? You refer them out. You say you should talk to a financial advisor about that. Or I know an insurance agent who can help. Or you just give them a name and send them on their way. The referral takes you maybe 5 minutes. A quick email, a phone call, done. And it seems totally normal, right? And that's what most accountants do. But here's what most accountants don't realize. That 5-minute referral just generated somewhere between $10,000 to $50,000 in commissions for someone else. The financial advisor you just referred to, they just got paid substantially. And you, the person who built the relationship, who identified the need and made the connection possible, you got nothing. That's the referral trap. You're creating value and you're not capturing any of it. Now, if you're finding this valuable so far, I encourage you to subscribe to this channel. I put out content specifically for Canadian accountants about building profitable practices. Hit that subscribe button so you don't miss a future video. All right, let me put some real figures on this so you can actually understand the kind of difference we're talking about. The average independent accountant refers somewhere between 10 to 20 clients per year to financial professionals. Some practices refer more and some will refer less, but that's the reasonable middle ground. Now, what's the average commission on these referrals? It varies depending on the strategy, but for RSP strategies, you might be missing out on $2,500 to $10,000. And for corporate insurance strategies, which is what business owners often need, you're looking at $15,000 to $50,000 or more. Across my partnerships, the average commission per client strategy is about $23,000. That's a real number from a real case. So let's do the math. If you refer 15 clients per year and the average commission is $23,000, that's $345,000 per year. $345,000 that came from your client relationships that you helped create that went to somebody else. Now let's zoom out. If you practice for 20 years, which is a typical career span, you're leaving $300,000 on the table every year, and that's $6 million over your career. $6 million. And I want to be clear, I'm not saying you're doing anything wrong. This is how the industry has always worked. Accountants do taxes, financial advisors do financial products. Everyone stays in their own lane. But the question is, does it have to work this way? And the answer is no. Now, the financial cost is significant, but there are actually 2 other costs that most accountants don't think about. The first is client retention. When you refer a client to an external financial advisor, something interesting happens over time. That advisor starts meeting with your client regularly. They're having deep conversations about goals, family, retirement, and legacy. Meanwhile, you see your client once a year for their taxes. So who do you think becomes the trusted advisor over time? The data shows that approximately 40% of clients who get referred to external financial advisors eventually migrate their entire financial life to that advisor, including finding a new accountant that the advisor might recommend. So you're not just losing commission, you're potentially losing clients. Clients you spend years building relationships with. The second hidden cost is the practice valuation. When you eventually sell your practice or bring in a partner, your valuation is largely based on your revenue and its predictability. Accounting practices without diversified revenue streams typically sell for 1 to 2 times the annual revenue. Practices with recurring revenue streams like ongoing commissions from financial strategies can command 4 to 6 times its revenue. So, the same practice with the same clients can be worth 3 to 4 times more depending on how revenue is structured. The referral trap isn't just costing you income today, it's costing you client relationships and long-term practice valuation. So, if you're a Canadian accountant and want to understand what this offer could look like for your specific practice, I offer something called a shadow audit, where we look at a few of your client files and we identify the potential. There's a link in the description down below that will help you to learn more about that. But let's keep that going because I want to explain what the alternative actually looks like. So if the referral trap is the problem, what's the solution? The alternative is what I call a partnership model. And I want to explain how it works conceptually because this isn't about my specific business. This is about understanding that a different structure exists. In a partnership model, instead of referring clients out, you partner with a financial services team. When you identify a client need, you make an introduction, the same way you would with a traditional referral. Instead of that being the end of your involvement, you remain part of the relationship. The financial team handles the strategy, the implementation, the compliance, the ongoing servicing, and all the technical work. And you share the commission, typically 50-50. Let me give you a real example to illustrate this. One of my partners, Asim, is a CPA in Ontario. He had a client, a 47-year-old business owner, who had access cash in their corporation. A classic problem a lot of accountants see all the time. In the old model, Asim would have said, you should talk to someone who can help with that, and referred them to a financial advisor. Instead, Asim made an introduction to our team, 10 minutes out of his time. Our team designed a corporate life insurance strategy. The client implemented it with an annual $50,000 premium. Asim's commissions were $23,400 for a 10-minute introduction. And here's the key part. Asim didn't have to become an insurance expert. He didn't have to run the client meetings. He didn't have to handle compliance or the paperwork. All he did was he identified a need, made an introduction, and participated in the outcome. That's the partnership model. Same work you're already doing, just structured differently. Now, I want to be transparent with you about what that requires because it's not completely frictionless. To receive commissions in Canada, you need to be licensed. Specifically, you need to be what's called a LLQP license, a Life License Qualification Program certification. This is a basic life insurance license. It's an online course that most people complete between 2 to 4 weeks, studying part-time around their existing work. You don't need to become a financial advisor. You don't need advanced designations. You just need this basic license to legally receive commissions. So is it an extra step? Yes, but it's a one-time investment for a few weeks that can generate returns for decades. The partnership handles everything from strategy design, the client meetings, the implementation, the compliance, the ongoing service. Your role is to identify the opportunities and make the introductions. If you want to explore whether a partnership model makes sense for your practice, I'd be happy to talk. I do a free consultation where we look at your situation, discuss how this works, and see if it's a fit. No pressure, no obligation, just a conversation. Here's the link in the description to book that call. And if you found this video valuable, please hit that like button as it helps other accountants find this content. Subscribe if you want more education on building a more profitable practice. I'm Montague Seiko. Thanks for watching, and I'll see you in the next one.